Hey, welcome back. This is Joseph. I assume by this point you have opened up an investment brokerage account and funded your account with money. More than any time in the past, technology has made it really easy to own stocks and funds with a click on the screen. In this video, I will talk about what stocks or funds to buy if you're new to investing. Based on your investment approach, I will give specific tickers and review the performance and characteristics of each investment. At the end, I will share which funds and stocks I own currently. Some quick basics. A stock is a small piece of a company. An ETF is a basket of stocks that owns pieces of different companies. A mutual fund is like an ETF in owning a basket of stocks, but more actively managed by a manager, and you can trade the fund only once a day. An index fund is a fund that tracks an index like the S&P 500 index. Funds outside of index funds can be thematic, like companies that's involved in cloud computing or innovative technologies, or these funds can be sector or industry specific, like energy sector or the airline industry. Passive and diversified. Warren Buffett's simple advice for your investment portfolio is to put 10% in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He believes the long-term result from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. If you believe in passive and long-term investing, or you're starting out and don't want to lose all your investments, the Vanguard S&P 500 ETF will work well for you. The ticker is VOO. It simply tracks the S&P 500 index of primarily US blue-chip stocks. The S&P 500 index has returned 267%, including dividends for the 10 years ending on December 31st, 2020. Vanguard's VOO and similarly iShares IBV or State Street Spiders SPY have returns that closely tracked the performance of the S&P 500 index at minimal expenses. Obviously, you will experience ups and downs because the companies in these broad and diversified funds will experience good times and bad times. But over longer periods of time, these companies will grow and generate earnings, and their stock prices should rise over time. And when these stocks or funds get oversold, it means they're on sale. That's when you buy aggressively. If Warren Buffett's advice is not enough, then you should also listen to Jack Bogle, an avid investor and money manager. He preached investment over speculation, long-term patience over short-term action, and reducing broker fees as much as possible. Passive and thematic. If simple buying and holding broad index funds are too boring and you're interested in specific themes, then only thematic funds or groups of stocks will fit your style. This is slightly riskier than the diversified approach we just talked about. But if you pick the right themes, you can get higher returns than the broad stock market over time. There's no one thing that fits everyone's interest, and themes constantly change. For example, energy was a great investment in the early 2000s. Innovative technologies worked really well in the 2010s. There are too many funds to list here. I'll just give two examples. Invesco's QQQ is an ETF based on the Nasdaq 100 index, and it consists of the 100 biggest domestic and international non-financial companies listed on the Nasdaq. It has annualized 20% return for the 10 years ending on December 31st, 2020, higher than the S&P 500 index 14% annualized return in the same period. On the other hand, the Energy Select Sector Spider Fund XLE hasn't done so well. It has annualized negative 3% return for the 10 years ending on December 31st, 2020, significantly lagging most other funds. So make sure you clearly understand what drives the theme and the underlying stocks the fund owns before your purchase. Passive and quality stocks. The third approach I recommend for beginners is to buy quality companies. You should first look at the industry and see if it's growing. You should avoid dying industries. Then try to find out if the company will become or remain a leader in the industry. Next, look through the company's fundamentals like earnings, growth, management quality, future plans, etc. to determine if it's a quality company. Finally, you should estimate a range of the company's valuation. This process is called fundamental analysis. I'll dive deeper into fundamental analysis in another video. Examples of quality companies are Apple, Microsoft, and MasterCard. These companies are industry leaders that are stable and growing. These companies are well run by management and show concrete earnings and future plans. Valuations are within reasonable range. Obviously, this is a progression. Between buying diversified funds, thematic funds, and quality stocks, there is no one right way of starting investing. Depends on your comfort level and knowledge. You can start by owning diversified index funds, then add other thematic funds and quality stocks as you become more educated and experienced. You probably noticed that I have recommended passive buy and hold strategies for beginner investors. I did that on purpose because most people and active managers underperform a simple passive strategy. With 10% average market return annually, you will end up with more money in 10 years, 95% of the time based on history. So what do I own currently? The biggest position I have in diversified funds is SPY, an S&P 500 index fund. I try to be disciplined by investing money I don't need every month. When I have no better ideas, I simply buy an index fund to make sure my extra cash is invested. The biggest thematic funds I have is SKYY, a cloud computing ETF. I have this fund for a while now and it's done really well for me. I also have funds that are invested in oil, airlines, and innovative technologies that I picked up in the last year as a lot of stocks and funds went on sale. My biggest position in stocks are Amazon and Alphabet. They fit the profile of leaders in growing industries with strong fundamentals, capable management, and acceptable but high valuations. You should still assess your situation and do your own analysis, but this should give you a place to start. That's all for today. I'll move on to intermediate and advanced investing in other videos. If you agree with how I approach beginner investing, please give me a thumbs up, comment below if you have more questions. I'll see you soon.